Setting financial goals, investing, and financial planning are an essential part of your business. Join me in the Absa Women in Business Masterclass series as I share insights on investing, financial planning, strategic business management, and so much more.
Good afternoon and a warm welcome to everybody. Thank you for taking time to be with us this afternoon. My name is Banji Lufungulo. I am the Head of Enterprise for Women and Youth here at Absa, and I'll be your moderator for this afternoon session. So before we start, just allow me to go through some house rules. Firstly, we kindly request that all the attendees put their mics on mute, and also your camera. So your mic and your camera should be on mute for the duration of the presentation. We will have a Q&A session where you will have the option to ask a question. You can either choose to post your question in the chat, or you can raise your hand and we will be able to see your hand and ask questions accordingly. So the Q&A will come right at the end of the presentation today. And then just for you to note that this session is being recorded. As you can see, it's already being recorded, and we will provide a light version of the entire presentation after the session. So we often do get a request that the presentation, whether the presentation will be shared or not, but we will have a light version of that will be shared at the end. So maybe now we can talk about what has brought us here today. It's often believed that a business has to achieve a certain level of growth or success for it to start thinking about investment. Last week, we looked at financial management and the importance of financial planning and how it is a critical process for any business to effectively manage its financial resources and achieve its strategic goals. Similarly, investments are said to be an effective way to put your money to work for you and also potentially build wealth. So today we are pleased to have in our audience Ms. Lyapa Mpempulwa, the CEO and co-managing partner of Money Acumen Advisory, which is a premier advisory and wealth management firm that specializes in building personalized and balanced investment portfolios to suit clients' individual investment goals. She's a renowned investment and financial advisor licensed by the Securities and Exchange Commission of Zambia. Through her career, she has achieved numerous accolades, such as the 2024 prestigious Governor's Award for Leadership in Zambia. In 2020, she was also recognized for her individual contribution to the financial literacy drive by the Bank of Zambia. Money Acumen, the business that she runs, as I initially indicated, has also been honored with the Governor's Award for Investment Awareness, further underscoring its role as a trusted partner in financial empowerment. And I think we all want to have that trusted partner when it comes to our money. Lyapa serves as a member on a number of boards, such as the Capital Markets Association of Zambia. She also serves on boards of fintechs and pensions as well. Her strategic acumen, dedication to fostering sustainable investment practices, as well as her client-centric approach, makes her a leading figure in the financial services sector. So ladies and gentlemen, and I do know last week we had a number of gentlemen, so this is not just about the ladies. So ladies and gentlemen, please allow me to welcome our host for today's afternoon's masterclass, Lyapa Mpempulwa, who will lead the topic of financial planning and investment. Lyapa, welcome to today's session.
Thank you for having me, Banji. I'm excited to be here.
No, thank you so much. So maybe as we start, I'd just like to ask a question. Investment opportunities for businesses, particularly MSMEs, are often deemed limited. So when you look at it, whichever landscape, whether you're looking at it from a regional point, a global point, when it comes to SMEs, I think there is a perception that investment opportunities are limited. How are we able to improve their global outlook and support these particular enterprises to achieve growth opportunities and become more profitable? So Lyapa, I think this will kick off our session for today. Thanks.
Okay. Well, for starters, we need to be cognizant of the fact that we exist in emerging markets, especially if we're looking at businesses in countries such as Zambia. So the first thing you are looking out for is, how do I compete with SMEs and SMEs in other regions? Yeah, and that starts with one, positioning yourself as a bankable business, and also looking out for opportunities in selective industries that makes you a bit more attractive to how investors out there perceive you as a business, as an upcoming business. Yeah, and also looking out for economic and market trends and what that entails for your business and the effects it then has on your business. Also looking out for items like market risks and the ever-changing behavioral finance aspects that are expected of you to tailor yourself to as a business. All of these then sum up to position you in a place where you are attractive, more importantly to investors out there. Yeah, I know we can speak to a lot of items, but for me, I believe in one, being bankable, and what are some of those key items that you need to put in place for you to be a bankable business, for you to expand and compete in the global markets.
And I think, Lyapa, you've brought in an important aspect around the fact that enterprises must be bankable at the end of the day. And I think this becomes the genesis of financial planning, and where you come in as an expert. I mean, just reading your bio, if I can say, you are a powerhouse when it comes to investment, and maybe that is the voice that we don't really have, or we haven't had the opportunity to actually be able to understand how financial planning and investments are interlinked. So maybe if at this point you are able to take us through your presentation for the day, that I think for me will be able to outline how the two interlock, almost like your jigsaw puzzle. If one is not there, then you will not be able to achieve the other. So I think at this point we can get into your presentation. Thanks.
Yeah. Thank you, Banji. Thank you, everyone, for joining in, and also thank you to Absa for this series. I know part of what will be discussed today was spoken to in the previous presentation, in the previous masterclass. So we'll just add on and see if we can add a little bit more meat to it. Okay. As earlier introduced, my name is Lyapa, and our session for today is pegged business financial planning and investing. So just a rough introduction, or high-level introduction. Financial planning and investing is, of course, an essential part to success when it comes to any business that's looking for long-term sustainability, and also having in place effective management systems ensures that a company has all the resources to grow and also just withstand economic downturns. But more importantly, we're looking at how you can maximize your profitability as a business. And today we'll just look at some of the key principles, some of the strategies, and more importantly, some of the real-world applications of business financial planning and everything investing related. Okay. So to kick off, what really is business financial planning? It's simply the process of managing your finances as a business to achieve your long-term objectives. I know we speak a lot to short to medium-term objectives, but a business also has medium to long-term objectives. And this is why we see big businesses or bigger institutions flourish, quote unquote. It's because they put in place medium to long-term plans and set out medium to long-term objectives. And it also involves key items like budgeting, forecasting, cash flow projections, assessing your risk as a business, investment management that falls a lot into investment decisions, and also cash flow management, which ties into your cash flow projections and how you monitor this on either a month-by-month basis or quarterly basis. Okay. So some of the key components to look out for when it comes to business financial planning, like earlier mentioned under budgeting, we hear budgeting a lot nowadays, and it's also easy for it to sound monotonous. But some cliches are cliches for a reason. For any entity to survive, or for any entity to perform well, you need to sit down and do your budget allocations, or just do a budget altogether. Okay, so budgeting is simply allocating financial resources to different business activities. Okay, so your business has different units to it. It has different activities to it that need funding, and you then realize that the only way you can stay functional as a business is coming down to the genesis of it and create a functioning budget that is very realistic to your business, something that's very tailored to your business. That way, you're able to project your revenue for a certain period. You're able to project your expenses for a period, and overall projecting what your profits then look like. So those 3 tiers are very essential to advising either the business owners or the unit it is that you're heading as an individual. Okay, and the next one is forecasting. Very similar to a budget. Forecasting or cash flow projection in this sense allows you to look at past data, look at future plans that you have, and then narrow down the 3 key areas like we spoke to earlier, which is 1, your revenue. Right in the middle there, you have your expenses, and then at the bottom you have your profits, which is your bottom line. Once you do this, it's very easy, one, to not just communicate with the stakeholders in-house. It also gives the business a broader picture to external stakeholders that you're communicating to, speaking to where the business is going. Is it a going concern? And okay, so cash flow projections under forecasting will speak a lot to, again, revenue, expenses, and also tailoring in market conditions. We also have the risk management bit of the business, which will help identify and, more importantly, mitigate some of the financial risks that exist out there. We have market risks, we have economic risks, and now we are in 2025 going into an election year. There are also political risks. How do these risks influence your business, or what risks are posed towards your business? So you want to understand any change in the market, any risk that exists out there, and how it is affecting your business. And also we have capital allocation, which just simply speaks to efficiently deploying financial resources for growth. Okay, under capital allocation, we are looking at the capex and the capital expenditure behind your business. You need to identify some of the key items that fall under your capital expenditure, and if those speak to expansion of your business, you also need to run your numbers before place some funds into your expansion and your capex. We also have tax planning and structuring your finances to optimize tax obligations. We live in a highly taxed country. You want to understand what taxes apply to your business, and how best you can maneuver around your tax, and not tax avoidance, but just planning around your taxes and which ones apply to you. Also, if we're speaking to investments, you realize that in Zambia we have investments that where income tax applies to, and we also have investments that grow at a tax-free rate. So even before you make any investment decisions, you want to ask yourselves which investments have tax included to them as they grow, and which ones grow tax-free. Okay, and the third bit around understanding business financial planning is business budgeting. So we spoke to earlier that business budgeting simply spells out how well you allocate each line item on your budget for your business. Okay, so there's a case study, or just an overview here, looking at a business that is projecting that you will make 5 million kwacha at the end of the year. This is how your allocations would then look like. We have operation expenses, speaking to 50% of the revenue. And we have marketing and sales, which will speak to 20%, research and development or innovation, 10% there. We also have debt repayment. You're a business, so chances are you'll be procuring some debt at some point. 10%. We also have savings and investments, 10%. What this does is you are telling your funds or your monies where to go, other than wondering what happened to the revenue that you made in 2024 or in 2025. And that's why setting up a budget is very important in any business. Okay, so this can be tailored. Same line items can be tailored to any type of business. But the key items that you should look out for is how much is going towards operation expenses, how much is going to marketing, how much is going to research and development. How important is research and development in a business? How much should we borrow, and how much can we afford to put towards our interest payments, and how much are we saving and investing in the year 2025, for instance? Okay. That way you can keep your expenses to an absolute low and find out really if your business can expand and how much it will cost you altogether to expand. And in this case, we're looking at research and development. If we put in 500K towards research and development, what are we looking to get out of there? How does that position us, to either maximize on our income or reduce our expenses or expand altogether as a business? But these things need to be put in a very systematic way and, something that you can clearly track. And this is why business budgeting is very important. If big businesses do it, you as a small business owner or as a medium business owner should be doing this. Okay, you can track your budgets on a quarterly basis, on a semi-annually basis. You can always revise your budgets as you go, but a budget is a non-negotiable. Okay, the second bit of our conversation is around investing in business growth. So the first thing that comes to mind when we speak to investing is the investment vehicles that exist out there, or investing in different types of assets. But there's a part to investing in business growth that directly impacts your business. Okay, before we speak to external investing. And the first bit is what we'll speak to. So the first one is capital expenditure, which is your CapEx. And this is just investing in fixed assets within your business, like machinery, tech, and real estate. Okay. Again, you want to run your assessments. If we purchase new machinery, do we have, why are we purchasing new machinery? Is it for a new product or a new service that we're looking to start offering? Have we done our research? Do we have an already existing market waiting for us before we can expand and put in a whole lot more money into our capex? Okay, if it's technology, how does this help our clients? How does it help our business altogether? Overall, what is our return on investment either? And what is our payback period? So are we looking at 3 years? Are we looking at 7 years? Are we looking at 10 years? And what impact does that have on our business? So CapEx speaks to a lot of variables. And as a business owner, you want to run the numbers first before you can, put down that expenditure. The next part is capital expansion, which is entering new markets or launching a new product. Very similar to research and development, like we spoke to earlier, and also speaking to CapEx. Before you look at market expansion or entering into a new market altogether, have you done comprehensive or very extensive research? Do you already have, do you already have a market or a clientele waiting for you? Are you leveraging on your already existing clientele, and just, expanding your business altogether? There's certain key questions that you need answered before you can implement. We also have the human capital development bit, which speaks to employee training and leadership programs. This might look like you're doing a favor to your employees, but what you need to have in the back of your head is your business is solely dependent on the employees that you have, because then they invariably speak to the business that they're bringing in, or the funds or the revenue that is being brought in. The quality of your human capital will determine how much revenue comes into your business. So this then translates to this being a proper investment. So look at employee training, look at any type of programs that you feel your employees would benefit from and your business will then benefit from. We also have tech investments. We are now going the route of AI, automation, and digital transformation. Best believe that consumers will pick a competitor over you over the tiniest things that speak to convenience. Yeah. Things like, do I have access to my statements online? How fast can I get this done? Okay, how efficient are your systems? And this speaks a lot to tech investing. So you want to integrate that into your business, no matter how small it is, because everyone is looking for convenience and an easier way of getting things done. So capital expenditure, market expansion, Etsy development, and tech are some of the key items you're looking at when you are investing into your business before you look at external investments. If we're looking at, which is the next bit, looking at investing in business growth, this is where now we start looking at return on investment, payback periods, and the different types of investment vehicles that exist out there for you. But before you put in any money, your ROI is something you need to know upfront. Your investment decisions are usually or solely reliant on return on investment, which will measure your profitability relative to the investment cost of the principal pumped into that particular investment. Okay, and there's a simple formula there that speaks to net profit over cost of investment times 100. Finding that number will help ascertain if this investment decision you're about to make is viable and if it's something that you should undertake in the first place. We also have NPV, which simply just evaluates the profitability of long-term projects. And more importantly, we have the payback period, which is time required to cover an investment or to recover the principal that you've put into that particular investment. So these are some of the key items you're looking out for before you make any investment. Okay. So we have a case study here because now we are being influenced by, tech businesses. So assuming anyone in the room right now decides to go into tech. A tech startup invests 2 million in research and development and a new product development at that. And after 3 years, the new product generates an annual profit of 1.2 million. So for us to find out the return on investment on this particular investment that this tech company has made, what we're simply doing is we're multiplying the 1.2 by the number of years, which is 3 years, lessing the capital injected in it over the principal or the capital itself, which is 2 million. Okay. In the end, we find that the ROI on this particular investment is 80%, which is fantastic if you ask me. So before you make any investment decisions, these are some of the numbers that you are running. How much are we likely to make? If we decide to expand into this market, into this product, or introduce this service, if your projections are stated at 500,000 kwacha or 1 million, how does this look like over the course of 3 years against how much it will cost for us to introduce this product or this service in the first place, so expand into this market? So you run such numbers, then you make a decision thereafter. Okay. So that's a bit on financial planning and investing, and we'll circle back to some of the investment vehicles that are available to you, or we'll just go in bits of details when it comes to that. But the next part I want us to look at is business financing and capital structure. So some of the sources of business finance that exist out there are debt finance, venture capital and PE. We also have grants and government funding, and also equity financing. But before I jump into this, I want to demystify some of the myths that exist out there, saying, banks don't offer financing, or, you can't get financing anywhere, and true as that may be to your own experience, we want to take 2 steps back and understand why we're not, getting the financing that we so desire. at the start of this conversation, we spoke to you being bankable as a business. So part of being bankable means you need to have certain key items in place. Okay, things like financial history. Are you keeping track of your finances as a business? Because remember, the financiers are looking for some form of a track record before they can offload the funds that you're looking for. Okay, and one other thing you need to keep in mind is, as the bank gives you these funds, there's another person on the other side, that has, whose funds really belong to. So this is not money waiting to be offloaded. This is someone else's funds on the other side that's looking for an opportunity, which are investment opportunities. So you want to have that in the back of your head, okay, so that it doesn't look like a gamble when the funds come out to you. Are you a bankable business? Okay. Can we clearly assess where your business has been, and more importantly, where it's going? And that's why the cash flow projections will help you as a business. Your budgeting will help you as a business. There's a part for debt in the budget, like we spoke to earlier. Have you already done your assessment so that you don't fall prey to getting into expensive debt or overexposing your business to unsustainable debt? That all these things that you want to look at even before we start the conversation on debt. But more importantly, you don't want to leave room where your business does not qualify for financing. You want to put all these things in place so that you're bankable as a business. So the first one is debt financing, which speaks to bank loans, bonds, and lines of credit. Okay, so for bank loans, Absa does have women in business, and there's a unit specifically dedicated to women and businesses. Okay, so you want to find out what it is or what will take for you and your business to qualify for this particular financing. And if you don't qualify today, I'm imploring you to get back to your books and ensure that you put things in order. So next time you're looking to expand your business, or you're looking for a product or a service, or something to be funded by a bank or by your bank, you have all those items in place. Okay, and there are also lines of credit which exist in different types of institutions that you have great working relationships with that can help with debt financing. We also have VCs and PEs. So venture capitalist firms work in the forms of funds. So there's a fund seated out there looking for opportunities in different types of markets or different types of industries. Again, the same principle. It's someone else's funds. Okay, it's different institutions, different individuals pulling funds and looking to invest in, bankable businesses. So you want to ensure that you have all these items in place, so that when you go to a VC or a private equity fund, you are attractive to the investor, and get the financing that you so desire. And on the other side, remember that we have investors that are looking for a certain return, and what you're doing is you're providing an opportunity for them to grow their principal altogether. We also have grants and government funding. These are non-repayable business funding. For grants nowadays, grants have been structured in a way that they come with business support. So before they give you the financing itself, they take you through, incubation processes, teach you different types of, financial management, and just so that when they give you this non-repayable funding, you're ready to take up the responsibility that comes with it, or else it becomes unfair to deserving businesses. So all these things fall in the same ballpark, having your affairs in order. Okay. We also have equity financing, which is raising capital through stock issuance. We have the LUSE now in Zambia. Well, it's been in existence for quite some time. It's becoming more robust, and you hear all these conversations around, we want more businesses to be listed in the stock market, and so on and so forth. You can sit down and find out what the process is to have your business listed, so more investors can pump in some funds into your business. And all these are opportunities that exist out there for you. But more importantly, for you to expose yourself to such opportunities, you need to have your affairs in order. I can't emphasize that enough. Okay. So sources of business finance come with certain ratios that you need to have, in check. The financiers are looking for businesses that are stable, and they'll run you through they'll run your numbers through different types of ratios. Okay, so this is just a high-level illustration of how businesses are picked when they're about to make a decision in terms of financing. So we have, I'll read this through. So the ideal capital structure balances debt and equity to maximize profitability while minimizing risks. We have three different types of companies here. We have a debt ratio on one end, and we also have a return on equity on the other end. Okay, we have a company like Company A, which has a debt ratio of 40% and a return on equity sitting at 15%. We also have a Company C with a debt ratio of 80% and a return on equity at 10%. Company C is not a bankable business. Okay, their debt ratio is high, their return on equity is low. Company A has their debt ratio in check and their return on equity is relatively high also, or it's good enough. Okay, so what you want to do is to ensure that your debt ratio is kept at an absolute low, or is somewhat in line with the return on equity. That way, it shows that your business, one, is a going concern, and two, this is a bankable business. And it also speaks to the leadership behind that particular business. How do they make these business decisions? Okay, are they acquiring expensive debt? And that ends up choking them, like the 80% debt ratio that we have here for Company C. A company like Company B, which has a high debt ratio but a relatively high return on equity, is seemingly still in the green. Okay, so you either want to be, in this case, you either want to be Company A, which is doing fantastic, or Company B, which has their debt affairs in order whilst growing their return on equity. Okay, so there are quite a number of items that financiers are looking for before they give you the funds that you're looking for. And a lot of things fall under behavioral finance and again, business investment decisions. And I speak from a business owner's perspective. There are a lot of biases that we have as business owners that influence the investment decisions that we make. And what I'm asking for is for us to come back to the drawing board and become a bit more self-aware. Okay, this also speaks to the type of risks that we take up on an individual basis and how this affects the type of risks that we take on behalf of the business. If you're a high risk taker on an individual basis, chances are you are a high risk taker in your business. Okay, but there's certain investments, high risk investments that you as a person can withstand that your business can't withstand. Okay, so you want to draw that distinction. That way your business doesn't suffer the consequences that you would suffer on an individual basis. Okay, but if we go back to behavioral finance and some of the biases that exist, the first one is overconfidence bias. And overconfidence bias, simply put, is just overestimating returns and underestimating risks. Okay, when you're doing your cash flow projections, overconfidence bias speaks to, I feel my business is going to make a lot of money. Okay, high level, how is it going to make a lot of money, quote unquote? You haven't sat down to look at the different types of risks that exist in your industry, in your market. What could possibly go wrong? What is the best case scenario? What's the worst case scenario? So just because you're an expert at what you do, that fact itself doesn't eliminate the risks that exist in your respective industry. You want to come down to reality and run your numbers, or run your business through the different scenarios that exist out there. Okay, so we need to stop overestimating our returns, work within realistic margins. So even if we speak to growth, yes, it's okay for you to say, I'm looking to grow my business between 25% to 40% in the next coming year. But you hear small to medium businesses saying, I want to grow my business from 50% to, even as high as 200% in the next coming year. That sounds great overall, but is it realistic? Okay. If you find yourself making investment decisions of overestimating of returns, this is where mistakes like, overborrowing comes in. Why? Because you're overestimating your returns. Okay, or expanding prematurely come in. Why? Because you're overestimating your returns without factoring in the realistic risks that exist in your respective industry. There's also loss aversion. So loss aversion simply speaks to avoiding investment risks, leading to missed opportunities. Okay, so yes, we have individuals that are very risk averse, but the downside to you being risk averse are the investment opportunities that you're missing out on. So in as much as we have individuals that are high risk takers and are very overconfident, we also have individuals that are on the extreme side of the scale that are very risk averse. Yeah, and in that case, you then shy away from making investment decisions, which then end up in missed opportunities. We also have the herd mentality, which simply speaks to following market trends without independent analysis. Okay, so just because you've seen a competitor do something a certain way, you go into the wind without doing your research. Okay, just because another person has launched a new product or expanded into a new market, you quickly run into it and think you can place your product or your service right next to them, but you're not understanding the strategy behind their reasoning or why they're doing that. Okay, so that's why research and development is very key, and that's why it appeared on our budget earlier. Find out why that trend is, it's going around in your industry. Why are people doing this? Why are they introducing this product or on their books? Why is the service being introduced? And again, come back, run your numbers like we did earlier, and see if it makes sense for your business. Okay, there are a lot of variables that apply before you expand your business or before you introduce a new product and service. And today, I just want you to circle back to all those key investment decisions before you press play on it. Okay. The next part is how to mitigate bias in business finance. 1, use data-driven financial models. We have a lot of financial models out there that you can simply download, punch in your numbers, and get the results and the ratios that you so desire before you make an investment decision. Okay, and you please bear in mind that you can never go wrong from collecting a lot more data. Okay. That's where research and development comes in. That's where market research comes in. The more data you have, the better you are to make financial decisions. And also diversifying of your investment portfolios. We have a saying, it's a cliche for a reason, don't put all your eggs in one basket. Find a way of diversifying your investment portfolios as a business. Okay, there's a part for reinvesting back into your business. There's also a part for investing in investment vehicles that are not in the same industry as your business. You can go into the traditional passive income investments that exist out there. That way, your business is cushioned just in case of just in case any of the market risks that exist out there come into play into your business. And also seeking professional financial advice. I believe in experts, be it in-house or internally in your business, or seeking external financial advice. An expert is an expert. If you need to hire someone who understands financial management and how to run a business from the financial perspective, please do. Okay, be it on part-time basis or full-time basis, I'll implore you, please hire someone for that particular reason. Okay. So there's some practical investment strategies that we can follow as a business. The first one, like we spoke to, is portfolio diversification. So businesses should diversify investments across different asset classes. We have stocks, we have bonds and fixed income, we have real estate, to reduce on risks. Okay. So some of the downsides I've come to realize over the course of time for clients that we manage at Money Acumen, especially SME and MSMEs, is the need to reinvest 100% of your profits back into the business. Okay, I understand that your business is doing fantastic and it's doing well, but you also want to understand the risk of reinvesting 100% of your profits back into the business. Okay, yes, it grows your retained earnings, but what if worse comes to worse? Okay, what if the year is 2018 and COVID comes the following year, and your business is not one of the lucky ones, that can withstand, such an unforeseen circumstance or the pandemic itself? There's some businesses that made it through COVID. There are also some businesses that didn't make it through COVID. A lot of businesses needed to take pay cuts and downsize and so on and so forth. Okay, but there's certain businesses that had cushions in other investments, in other investment vehicles and that were able to pull out those funds and keep their business afloat. Risk applies everywhere, and you want to be prepared for the different types of risks before you can pump 100% back into your business. Okay, and hence the principle of portfolio diversification. So the first investment vehicle that we're going to look at is real estate investing for businesses. I know a lot of us are privy to real estate investing. It's a traditional investment vehicle, and every time anyone mentions investing, or if I were to, put out a 1 million kwacha to every single person under the sound of my voice, a lot of us will go the direction of, let me invest in real estate. But before you go into the real estate business, you want to run your numbers. Real estate is not an emotional venture. It's a numbers venture, especially if you're doing this for your business. One, we have commercial property investing, which speaks to office spaces, warehouses, and retail outlets. Okay, so when you're looking at office spaces or real estate overall, the first thing you need to have in mind is location. Okay, if you're going to set up office spaces, you are speaking to location. You're thinking about location, which will then influence what type of businesses will rent out your space. Just if we brought it back home to Lusaka, not just even Zambia, Lusaka, for some people that are Lusaka based, we've seen a lot of commercial buildings, empty commercial buildings, almost at every corner of the road. A lot of money went into that particular investment, but the building has been vacant for the first 2 years after launching, or the first 3 years, or the first 5 years. So the business that invested into that particular investment still hasn't started making the return on their investment yet. Why? Because we get so excited. Real estate is such an emotional venture that we forget to run the numbers in the first place. There's a lot of adrenaline attached to it, a lot of excitement, and it makes for good conversation when you're seated with your colleagues saying, I'm putting up this building, it's going to be commercial property, and forgetting that even as you go to the financiers and ask for funding, there comes a point where, this will cost you a lot of money if you didn't run your numbers. So it sounds good, it looks good on paper, but you want to run your numbers in terms of location and the use of that particular property that you're putting up. Things like warehouses. Sounds great. You're having a conversation with your friends or your colleagues around, you can make a lot of money if you set up warehouses. There are ABCD industries that are in need of warehousing and sounds great. But the location of your warehouses also matters. Who is your client? in the location that you're setting up these warehouses. Yeah, who are your clients in the location where you're setting up these shops or these retail outlets? Everything in real estate starts and ends on location. That's it. So immediately you ignore location, everything else, your ROI, your payback period, will be influenced by the same point. The second bit is residential property investing. So you have rental, and we also have serviced apartments, or serviced rentals. Okay, when it comes to residential property, one of the key items you're looking out for is occupancy rate. Again, it's influenced by location. You can put up beautiful homes, beautiful apartments, beautiful 2-bed houses, 3-bed houses, and put in a lot of money. But if you put it in the wrong location, you then realize that you didn't do your research on who am I building these houses for? Who is my targeted tenant? Okay, how long will they stay in these houses? So a beautiful house as it may be, if I put it up in 10 miles or 15 miles, for instance, or I'll go the traditional route of, in Shantumbu Road or off Shantumbu Road, beautiful homes. It's a relatively beautiful location, but you put them out for 10,000 kwacha or 15,000 kwacha or 8,500 kwacha. Who is the client that will want to go to 10 miles, for instance, looking to pay 15,000 or 10,000 for your house? Okay, same house in Rhodes Park, for instance, can fetch for 25,000 kwacha. Location is everything. But if you put a house in a separate location, let's say in Woodlands, for instance, that house can at most fetch for 8,500 kwacha. So your investing is influenced by the location of your property. So even before you pump in all those funds to develop your property, you want to run your numbers. You run your numbers on payback period, you run your numbers on occupancy rate, especially if you're using, mortgage or equity release as financing for, erecting your buildings or setting up your properties. We also have calculating return on investment on your real estate portfolio, like we mentioned. Assuming your property is valued at 2 million kwacha, or that's how much you're putting in. If you put in 2 million kwacha as a principal, I would have loved for us to do some numbers. Put in 2 million kwacha, and assuming those are 2 houses, 2 rental properties, and they're paying you 7,000 kwacha every month, that's 14,000 kwacha per month. You multiply that by 12, we are looking at, just hold that thought, let me see if I can do some calculations for you, just so this is a bit more realistic for us, and we can look at return on investment. So if it's 14,000 kwacha a month times 12 months, we're looking at about 168,000 kwacha a year. So 168,000 or 2 million divided by 168,000, assuming your houses are at 100% occupancy, we are looking at plus or minus 12 years for you to get back your principal. Okay. As a business, can you wait for 12 years to get back your initial principal? Or are you putting up those properties, to use it as collateral for other investment opportunities that exist out there? So you want to run your numbers before you make that investment, okay? Which speaks to leverage on your business, on your property for business expansion, which is asset versus collateral, and also buy versus lease analysis. This is mostly for business owners that are looking to stop renting for their operations as a business and are looking to purchase a property for them to operate from. You want to run your numbers. Again, if we purchase location, one will influence where you set up your offices. If you're looking at commercial property, it costs you somewhere minimum 2 million kwacha. So 2 million kwacha against us paying rental pricing of 30,000 kwacha or 35,000 kwacha. You run your numbers, 35,000 kwacha, which is 420,000 per annum, against purchasing a property for 3.5 million, which translates to 8 to 9 years around 8 to 9 years just for you to break even. So you want to run your numbers if it makes business sense for you. Okay. So the next part is you investing onto the stock market. So when you look at investing on the stock market, we're looking at two key items, which is capital growth or dividends. We have different types of stocks, and we'll go through the different types of stocks that exist on the LUSE. But businesses can invest in different types of stocks. We have capital growth stocks, which will offer you stability, and these are usually bigger and well-established businesses. We also have dividend-paying companies, which will provide consistent passive income. It also depends on your in-house investment strategy as a business. We also have equity funds that offer diversified exposure with lower risks. Just in case you are looking to not go into the stock market yourselves as a business, you can always invest in funds that invest in equities, just so you get the same exposure. Okay. So when it comes to research and development, I just wanted to bring to your attention a company like Zambif, for instance. So Zambif invests highly in research and development. Okay. And we've seen the expansion. Just to give you context, Zambif's main commodity is not beef. It's wheat. And we've seen this happen. We've seen the expansion in the past 2-3 years. It should have been 2022, 2023, when they were working on the $250 million expansion. And we've seen their growth rate and their ROIs. If you look at their financials, it is fantastic. We've seen them expand into markets like Nigeria. So Zambif is Zambif group of companies. You have Zam Leather in there, you have Master Pork in there, you have so many of these other companies that are under Zambif. But they they invest a lot in research and development before they get into a new product, before they expand into new markets. And in as much as this is a big business, it's listed on the stock market, the same rules apply for small to medium sized businesses. And this is something that I want you to consistently have in the back of your head. And they also maintain a strong cash reserve for financing the expansions and also for acquisitions. So learn from the big businesses, then narrow it down to how can I implement this in my small to medium sized business. The rules are the same. The only difference are the quantums involved. Okay, so some of the key principles that I want you to have in the back of your head when it comes to long-term investing is 1, wealth accumulation. So money invested today grows significantly over time. So it's wealth accumulation for a reason, or wealth creation for a reason. So even as you're looking to have your business grow, you want to consistently do this over the course of time. You want to expand at at a normal rate. I use the word normal very deliberately. Why? Because we get very excited nowadays to expand prematurely. You want to take 2 steps back and say, listen, yes, my business is making really good money. Our revenues are fantastic, and I feel this is the time to pivot. Whilst that may work for some businesses, it might not be the right time for other businesses. Okay, so you want to take 2 steps back, see how your business is growing before you can make a huge leap. Okay, and also it's okay for you to have to amass a huge reserve of cash that you then translate into other external investments. That way your business has more assets. So focus also on accumulating some assets for your business, then look to pivot from there. And also inflation protection. Okay, so investing in assets that outpace inflation ensures purchasing power is preserved, be it on an individual basis or at a business level. Our current inflation rate is sitting at 16.8%. When you look at our bond offering for a 5-year bond is currently sitting around 19%. And you can see how quickly inflation is catching up. But you're not investing in a bond because the margin between a bond and inflation is low will not solve anything. What you need to do is invest. No matter how small the margin is, invest. Okay. The good thing is for you to always invest in investment vehicles that are at least beating inflation by some sort of a margin. Okay, that way you can retain the purchasing power of your money, and also participating in economic growth. Owning stocks and assets allows individuals to benefit from the economies that they exist in. We have the same notion. Again, demystifying myths. We have the same notion. No, we have investors coming from out of country. They're the ones that are, controlling our economies and. But the question is, who didn't tell you that you are not invited to the table? Okay, so all these businesses that we see, the major businesses that we see, are waiting for you to invest in, for you to be part of, the economies that you exist in. Okay, and we'll speak to that shortly. We'll go into government bonds. Okay, so the first investment vehicle in detail that we'll speak to is government bonds. I'm sure you've been seeing the social media frenzy around fixed income and government bonds, and it's there for a reason. People are trying to educate everyone around, investing and, taking advantage of the fixed income market. So what is a government bond? A government bond is simply a lending instrument. Who are you lending to? You're lending to the government of Zambia through the central bank. Okay. As simple as that, nothing complicated to it. There are bond auctions that are held every month, invitations or auctions rather, auction letters are released every beginning of the quarter. I think the bond dates have been released as of yesterday for the upcoming quarter. So you can read through to see when the next auction is coming up. It's also a fixed income investment. That means whatever it is that you agree on at onset of the investment is exactly how it rolls through up until maturity of that particular bond. It's also a medium to long-term investment. It has 6-10 years attached to it. So there's a 2-year bond, a 3-year bond, 5, 7, 10, and 15-year bond. So remember, anything that's 12 months and below is considered short-term. Anything that's 12 months and above, maybe up to like 3, sometimes up to 5 years is considered medium-term. And anything above 5 years is considered medium to long-term. Okay, so a bond is relatively considered as a medium to long-term investment. Also, it has regular income. You're paid coupons every 6 months. You have an annual rate that is then divided into 2, and you get paid your coupons every 6 months. There's capital gains in a bond, and I'll explain this. Before 2024, before 2024, we had the double income type of bond where you'd make money at maturity and also earn before maturity. Now we only have the coupons, and you only get back what you invested at maturity. But capital gains also speaks to you selling your bond on the secondary market. Okay, sometimes you can make, of course it's a bit different now with the revision, but yes, you can make some money off the secondary market and make some capital gains if you sell your bond before maturity, where you agree to a price and on the secondary market. Okay, and get some capital gains from there. It's also a low risk investment. It's not a risk-free investment. There's no investments, but it's a low risk investment. Why? Because it has the full backing of the government. Okay. It also has minimal capital. You can invest in a bond for as low as 1,000 kwacha. Okay. Of course, when you run your numbers, it might not make business sense that much, but it doesn't take away the fact that the entry to investing in this particular investment vehicle is very low. There's also income tax charged on it. So your coupons are charged a 15% income tax, and there's also a 1% management fee by Bank of Zambia that is deducted from your earnings. So total deduction come to 16%. And also we have the primary and secondary market depending on your preference. Okay, this is simply an invitation. I'm sure you've seen it in the papers, or you've seen it in online on their website, and this is simply an invitation to every person out there, both on in Zambia or offshore. Anyone that has money, can you kindly lend us some money so we can finance our projects as a government, and so on and so forth. Okay, so part of the reason why a government bond is considered low risk is everything you need to know about a government bond is told to you on the invitation. All the numbers are told to you upfront. The maturity date is told is written there. It's very explanatory. Everything is in black and white. There are no there's no fine print attached to it. Your maturity date, if we look at, let's say, the 2-year bond, this was the March auction. The maturity date for someone who purchases a 2-year bond is 17th March 2027. The coupon dates are told to you. There's a 17th September coupon and a coupon falling due on March 17th. Same thing applies to the 3-year bond, 5-year bond, 7, 10, and 15-year bond. Everything is told to you in black and white. There's also additional information here which tells you that one, the only reason why we will not pay you on those dates on the first page is if your maturity falls on a weekend or a public holiday. We'll pay you on the next business day, and everything we've spoken to, your tax and everything is told to you. So you make a decision based on the information that you've been given with no fine print whatsoever. You get these results after the bond auction, telling you where you stand and what the yields are for your coupon rates. This again is for the March 14th auction. The 2-year bond is currently sitting at 15.5%. We have the 3-year bond at 18.4%. We have the 5-year bond at 19.2%, 7 19.9%, 10-year bond at 21.4%, and 15-year bond at 21.8%. It will tell you the range of successful yield rates and the range of unsuccessful yield rates. They'll tell you what was on offer and how much was allocated. Okay, so everything again is in black and white. Just some calculations around if you invested in a 5-year bond, if you put in 500,000 into a 5-year bond, the yield would have been 19.2%. The tenure would have been 5 years. So your coupon payment before tax will be sitting at 96,000 per annum, which translates to 48,000 per 6 months, and then after tax you're sitting at around 40,000, 320,000 every 6 months. It's a very significant amount of money, especially that this is a low risk investment vehicle and it's also a passive income investment vehicle. So your total coupons, remember this is a 5-year bond, which then translates to you receiving 10 coupons. So if you multiply your coupons after tax, which is 40,320 times 10 coupons, your total coupon payments would be sitting at 403,200, which then translates to your return on investment plus principal sitting at 903,200. This is a fantastic number, seeing as this is a medium term that we picked on, the 5 years. Okay, you're making almost 100% of your money in just 5 years. Okay, so you want to explore this particular investment vehicle. How do you buy a bond? You can buy directly through the CSD system, or you can speak to your private banker, or you can speak to your relationship manager and how they can purchase a bond for you. Okay, so remember, compound interest is a time reliant. It's time reliant, and also it's considered the world's 8th wonder. So you also want to explore the opportunity of reinvesting your coupons. Okay, that way you can realize more money. Okay, The next part is stocks and shares. Okay, and this is the last investment vehicle we'll be looking at today. So simply put, stocks and shares speaks to you having ownership in a publicly traded company. Publicly traded company being the emphasis here. If you go to a private business, we call that private equity or PE. Okay, how do you make money off the stock market? We have capital appreciation and dividends. Capital appreciation is simply the difference in gains from the time of purchase to the current value. The next one is dividends, which just speaks to payments made to shareholders after a profit has been declared. I need to emphasize that dividends are not mandatory. Different companies that speak to dividends have dividend policies in place. Okay, and they will advise how they pay dividends and if and when they pay dividends. Okay. If we bring it back home, we're speaking to the LUCE. So just a bit of background about the LUCE. It was founded in 1994. It's a 31-year-old market. It's relatively young if you compare it to the big markets or the older markets that exist out there. Others are as old as the 1800s. Others started in the 1900s. So yes, the stock market has been in existence for a very long time, but ours has been in existence for 31 years. Young as it may be, it's a very robust stock market. Okay, we have 20 listed companies, and just so you know, we finished in the top 5 for the past 5-6 years. With 2021 and 2022 seen us finish as top performing, which means number 1 performing stock market in Africa. Last year we finished second, and again the past 5 years we've been in the top 5. So yes, it's a very well functioning stock market. 20 listed companies, we have 8 registered brokers. Money Acumen is one of the brokers, and also it averages around 20 to 24% per annum in the past 5 years, with the growth rate of 43% in last year alone. So again, very well functioning stock market. How do you pick a share, or how do you know which stock rather to get into? I must emphasize that in as much as as an investment advisor, I will never advise you to use your emotions when getting into an investment. We've come to realize over the course of time that emotions do come in when a client is picking which stock they should invest in, i.e., I shop with ShopRite, I want ShopRite shares. My children wear butter shoes, I want to buy steak and butter, and different reasons. And it doesn't always have to make sense to the broker or the investment advisor, but it is what it is. So maybe you're allowed to use your emotions when purchasing a stock, purchasing stake in a stock. But there's some other key items that you need to have in mind, like who sits at the helm of this business. Remember, these are businesses. Who is their CEO? Are they qualified? What is their track record of performing? Okay. How does their governance look like? Who sits on their board? Okay. How have they performed financially in the past couple of years? Of course, past financial performance does not influence future performance, but you want to be in a position to make that decision of their track record. What industry are they in? Okay, am I going into this particular stock because of capital gains or because of dividends? Are they a dividend paying company? What does the dividend policy say? Okay. And so on and so forth. Now there's ESG that has been introduced. Okay, so are you looking for a company that has proper ESG policies in place? And different variables, different reasons exist out there as to why people pick the stocks they invest in. Okay, like I mentioned, we have 20 listed companies. We can go industry by industry. We have, in the manufacturing industry, we have Chilanga Cement, Zambia Brew, Zamefa, National Breweries. Chilanga Cement, from the time it was renamed back from Lafarge to Chilanga Cement, again, market sentiment. Investors behave a certain way when it comes to the stock market. Market sentiments just simply went up because it was revised to Chilanga Cement. We don't know if it's the indigenous name. We have no idea. But it has played a role in as much as they've seen a competitor come on board. Dangote. But either way, the stock does fantastic. It's a fantastic stock to get into. We have Zambia breweries and national breweries. Okay, Zambrew makes the opaque beers. National breweries make, or sell the designer drinks. Okay, again, investors and consumers think very differently. You can either go for the Zambia breweries stock or you can go for the national breweries stock. Okay, at face value, a lot of us will go for the designer drinks, which then speaks to national breweries. Why? Because it's attractive. The Bruto, the Stella Artois, they look fancy to the eye. But an investor or different types of investors will look at the numbers. Zambia breweries should have been 2023 made in excess of 53 million in profits, while national breweries were seated at around 3 million in profits. Okay, so again, aesthetics translate differently to business performance. Another thing you're looking at is who are the clients, who's the end user for Zambia breweries products, and who's the end user for national breweries. Okay, Zambia breweries make opaque beers. That means they have a bigger market share, they have a bigger clientele base, and we've seen different types of introductions when it comes to opaque beers. We have the 20-liter Chivuk Shek. Yes, I think as an investor, 20-liter Chivuk Shek that has seen their revenues go up. And also they've introduced different types of flavors, and there's banana, there's strawberry, and the like involved. Okay, and also the 20-liter offering, there's a discount if you take back the container. Instead of buying it at 120k, you buy 20 kwacha rather, you're buying it at 80 kwacha. There are all these offerings that only speak to their ESG policies, the green policies rather, but it also speaks to retaining their clientele, okay, which has seen their revenues go up. So you also want to run some of the numbers and the trends that are going around in the stocks that you're investing in. We also have some method. In manufacturing and oil, we have Bata, Puma, Africa Explosives, and Zafico. Okay, Bata, again, Africans or Zambians rather will argue that my children wear Bata shoes, I'm going to buy shares in Bata. We have Puma, if you want to go into the energy industry or the oil industry. Puma is a great stock to go into. We have Africa Explosives. Just to give you context with capital appreciation, Africa Explosives in 2010 was fetching for 2 kwacha 19 ngwe. Is it 1 kwacha or 2 kwacha 19 ngwe per share? Africa Explosives is the first listed company on the screen. It's currently seated at 31 kwacha per share. So if you invested in 2010, imagine the amount of growth your stock portfolio will be seated at. Okay, that's significant growth. And we also have Zafico. We also have energy mining and investments. We have ZCCMIH. We also have CEC. So ZCCMIH is the umbrella under which all of our mines or mineral companies sit under. It was primarily set up for copper and the mines and so on. Yeah. So we have seen a lot of revisions when it comes to how ZCCMIH is paid. Yeah, we've seen movement from royalty-based payments from the mines to from dividend payments to royalty-based payments, which has seen the profits of ZCCMIH, go high. So you want to be a part of what's happening at ZCCMIH. We also have CEC. CEC now has previously launched their green bond. They're working towards green energy. We see their stock price going up every time they launch a new solar plant and so on and so forth. So you want to be a part of what's happening at CEC. CEC just 2 years ago, a share in CEC was going for around 2 kwacha 15 ngwe. It's currently seated at 13 kwacha 47 ngwe. And every time you hear in the news that a new plant has been launched, the share price reflects accordingly. So you want to be a part of it before it gets to the 30s, like it happened with Africa Explosives. In the banking sector, we have Standard Chartered and Zanaco. Insurance and finance, we have Zambia Reinsurance, Madison Financial Services. In agriculture and processing, we have Zambif, Zambia Sugar. We spoke to Zambif earlier. Zambia Sugar is also a premium company. We have property, real estate investment Zambia. So if you look at shopping malls like Espark Mall, Cosmopolitan Mall, Mokuba Mall on the Copper Belt, Kafubu Mall on the Copper Belt, Acacia Park now, Arcades Shopping Mall, Jacaranda Shopping Mall in Dola, all these are under the Real Estate Investment Zambia portfolio. So it's a fantastic stock. And now it's been revised into a REIT, and it's USD denominated. Okay, so if you look at REIZ USD, it's still currently trading under $0.10. So it's an opportunity. It only started trading late last year. Before you blink, this stock will be going for $1 or $2 or $10. So whilst it's still relatively low, you want to get in and buy as much stake as you possibly can. In retail, mobile, hospitality, we have Pamozi, Airtel, ShopRite, and British American Tobacco. I'll bring your attention to Airtel. Every time Airtel is mentioned, a lot of us will, have our own sentiments around, okay, no, I don't want to get into Airtel because of, my own reservations and. Yes, whilst there might be struggles on the MNO side, I want to put your attention to their mobile money offerings. Okay, it's the only listed company, it's the only telecoms company that is listed in Zambia. Okay, and mobile money transactions, like we've read, have surpassed banking transactions, and Airtel Money is benefiting from that. Okay, and we saw Airtel appreciate above 114% 2023 into 2024. It is an absolute premium stock, and it's currently seated at 60%. Year to date, it's sitting at 37%, almost 38% growth. Okay, so it's a fantastic stock. And also their dividend yield last year was 28%. Okay, marking it as the highest dividend paying company as of last year. So you want to explore what the offerings are on the stock market. We also have ShopRite. ShopRite year to date is currently seated at 25%. Again, this is high risk. This particular investment is high risk. Why? Because you're investing in businesses, and businesses either make a profit or a loss. But when you look at companies like ShopRite, for the longest time, ShopRite price was stagnant at 63, 64 kwacha. Okay, but that's what happens with stock prices. Then late last year into early this year, we saw a jump from 64 kwacha. A ShopRite stock is currently sitting at 320 kwacha. Okay, it's a dividend paying company, so you also want to explore that side of ShopRite. And we also have British American Tobacco. So there are quite a number of items you need to look out for before you invest on the stock market. Again, am I looking for capital appreciation, or am I looking for dividends? What are the dividend yields over the past couple of years? What are the dividend what is their dividend policy, and do they stick to their dividend policy? Okay, so just to wind our conversation down, I want us to look at how you can allocate your asset portfolio, and also how age plays a pivotal role and how you pick your investments and how your portfolio should look like. Okay, I speak from you as an individual, and also you being a business owner. Like I mentioned earlier, most of the times our investment decisions or our business decisions come from how we make investment decisions on a personal basis. Okay, so for young investors, and we categorize this by age ranges. For young investors between 20 and 30, you are in the aggressive growth stage. That means you are able to take up a little bit of risk, or let's even put it as much more risk. Why? Because the markets have allowance to correct themselves, and also, if something went completely down south, you can always, get back onto your feet and try again, and yeah. So making a bit more of high risk investments for maximum returns is somewhat acceptable between the ages of 20 to 30. Of course, informed investment decisions. And when we get to the middle-aged investor range, which is 40s to 50s, you're in the portion or in the group that speaks to balanced growth and stability, where you can expose your monies to some form of risk, in the effort of getting back some form of return. So moderate risk investments for stable growth. I want growth, but I also want some form of stability. And then we have people that are within the age ranges of, let's say, 55 and beyond. Here, your focus is capital preservation, low risk investments, focusing on income generation and security. Okay, you want to think hard and long how the investments not only look at your risk profile, but they also look at the objectives as to why you're making that investment in the first place. Yeah, if you're investing for your child's tertiary education, there are certain investment vehicles that you should refrain from, placing your funds into. If you are investing in a retirement fund, for instance, yeah, between the ages of 20 and let's say 40, you're allowed maybe to expose your funds to a bit more equity on your portfolio. Yeah, why? Because you have a bit more time until you get to retirement. The objective there being retirement. Okay, so retirement will speak to the type of investments you're exposing your money to and your current age. A 55-year-old can't expose their monies or all their monies into equity. A small part of their portfolio will sit in equity, whilst the most of it will be seated in fixed income. Why? Because they don't have the time, to allow for markets to correct themselves. What they're looking for is a bit more stability and, more importantly, just capital or principal preservation. Okay, I will end here so that we can take in some questions. Yeah, Bandi, are you there?
Yes, I am here, Lyapa, and wow, what a session, right? I think there is so much that has come out of this presentation, and I'm sure our clients have gained a lot of knowledge out of this session, which is really what it's intended to be. And I won't delve yet into some of the key aspects that I personally was able to take out. But maybe we can go into a Q&A, question and answer session from our clients. If you would like to pose a question to Lyapa regarding the presentation that has been put forth before us, please, you can raise your hand, and if you're comfortable, turn the mic on, or you can actually post your question in the chat box. So maybe whilst you're waiting for hands and questions to start popping up, I think for me, maybe just a quick overview, the key aspects of financial planning. We did hear you talking about budgeting, forecasting, or cash flow projections, as you called it, risk management, capital allocation, tax planning. And then when we came to the element of business investment, I think for me, two aspects hit home. You did talk about capital expenditure, which is your fixed assets, and I think you have spent a lot of time around that. But there was also an aspect of market expansion. How many of us are actually increasing our reach or getting into the next business, thinking we're diversifying, when in actual fact we haven't done our research? So research, I think for me, was a big takeout. Are we investing in R&D, research and development? It's something that we never think about. I think most of us just get into it because my sister may have told me, listen, there's a lot of money that you can make, within this type of business, but we actually don't do our numbers. So whether you are looking at even the investment in real estate, that's another one that has come out. How many of us are buying property, pieces of land, building in the hope that, you'll get your money back? So I think for me, aspects around knowing your numbers was so critical. And even the behavioral financing, the biases that we have, if I'm not a risk taker, definitely that will influence the business decision. So it's important for us to have a neutral person such as yourself, a business advisor, who can then be able to come back and tell us, okay, perhaps you need to go this route. And even in the bank, we do have different experts that are able to speak to clients around investments. So I don't see a hand or a question at this point, Lyapa. But I think for our clients, what I would like to just say is the email address was posted throughout Lyapa's presentation, and I will put it in the chat. It's moneyacumenadvisory.com. But also, if you are interested in just learning more about our Women in Business proposition, our email address, again, which will be posted in the chat, is womeninbusiness@absa.africa. So we do have one question, Lyapa, for you. Again, it's an anonymous user, so unfortunately I cannot call you by name, but it says, "Good afternoon, Ms. Lyapa. I would like to find out if banks in Zambia offer factoring services to SMEs. If so, are they efficient, and how can one take advantage of these opportunities?" So Lyapa, I think it's factoring services.
Factoring services, that's new.
Yeah, so maybe anonymous user, are you able to turn on your mic if you're comfortable and just pose the question directly? We also do have feedback from Maimbolwa Moto, who says this presentation was very educative. I have learned a lot. So anonymous user, we are waiting for you to just clarify on the question they have posted again. What do you think is the reason why some businesses are thriving in today's world, especially Zambia? For example, a graduate who has a startup, maybe why they're not thriving. I think that would be the question. So anonymous user, please, if you're able to unmute, we would be grateful to get your feedback because the question is not clear. But so maybe, Lyapa, as we are waiting, any final sentiments, any final thoughts to clients? We will be posting the 2 email addresses as I indicated.
Okay. I think for me, it's just echoing the sentiments from earlier. You want to be a bit more self-aware as a business owner by implementing what has been taught from the previous session, which spills a lot into today's session around cash flow projections as a business, doing your budgeting as a business, investing as a business, and also looking out for opportunities. And one key item for me being, are you ready to scale just yet? Yeah. And if we're scaling, what do the numbers look like? Okay, both in the short, the medium, and overall in the long term. Okay, and yeah, just get started. When it comes to SME and medium-sized businesses, I think we don't emphasize a lot in having assets as a business, okay, and investing as a business. For your business to also be bankable, one of the things that I've personally learned in the operations of my business is assets do speak a lot for you. And that translates to either financial assets, like we've highlighted, your bonds, your fixed income, investing on the stock market, or physical assets or your CapEx. Just having some form of assets for your business does help when you're looking for financing and expanding overall. So get to investing, speak to an advisor. You can come to Money Acumen and we can help you get started on that front when it comes to investing. I would really like to see more small and medium-sized businesses with financial assets.
Thank you so much, Lyapa. And as she has rightfully said, if you need more information, please be able to reach out to her. I have posted in the chat their contact email, you can drop them an email, and also you can contact us at womeninbusiness@absa.africa for more information. I think on behalf of the clients, Lyapa, I'd just like to say thank you. Thank you for such an informative presentation today. The whole aspect is really for us to be able to provide our clients with business advisory services and just to help them take the business to the next level. So to our clients, it's been great having you today. Please look out for next month's masterclass. So this is going to be monthly, and we will be talking about all things people. So your human management aspect is what we will be hosting next month. So please be on the lookout on our socials for more information. But from us, on behalf of the Absa team, we just want to say thank you, Lyapa, once again, and thank you to all our clients. Have a good and blessed afternoon. Thank you.